Today, we will be learning about the popular Martingale money management technique. Stick around to the end to receive a free expert advisor. So, to kick us off, what is the Martingale strategy or the Martingale money management technique? If you've been around the EA world for some time, or the Forex robot world, you would have seen that this term is mentioned quite often. Quite often sellers will say, oh, this bot is not a Martingale, and the term Martingale will be used quite often to critique different strategies. And from a very high level, Martingale is effectively, it's not necessarily a strategy, it's a money management technique. And it's based on roulette principles. And the absolute simplest version is every time you lose a trade, you double. So that the hope would be that trades, like your ultimate winner at the end, eventually will win a trade. If you keep doubling your position size, the one winner should be able to cover all of the previous losers just based on the properties of exponential series. And this is often seen in expert advisors when you have those beautifully perfect equity curves, however, or beautiful perfect balance curves. However, you will see these equity dips in your line because typically until it wins, the expert advisor will keep opening positions and it will simply leave them floating, which leads to that divergence between balance and equity. And moving to the next slide here, in expert advisors, how is Martingale typically implemented? And I wanted to really walk you guys through an example because I personally have actually developed grid Martingale expert advisors for my own trading before. So I am reasonably familiar with how they work and some techniques and how to make them better. So I wanted to really show a detailed example of how Martingale can be used and perhaps some better ways of actually doing it which are safer despite not being my personal preference, as the risk reward is simply not there. So in an expert advisor context, Martingale is often used using a grid. So the term grid can be represented by these four lines here. But what it essentially means is if you try and, let's say, take an initial trade here at the 1x, let's say it's a long, so you try and buy. If price ultimately goes against you, so you wanted it to go up but it goes down, the expert advisor will start to open recovery trades in a grid formation. So what that means is at a predetermined level, it will open a second buy position because it hopes that, hey, this one may have gone down, but it hopes to open a second buy here and for price to go back to this level where it would close both trades. This is an example of a 4-trade series, but effectively you first wanted price to go up here, but at a predetermined level, it will open another trade. If price still doesn't go up, it keeps going down, it will open another trade at the same distance, and then finally here, it opened a long trade, price went back up, and at that level, once the trade closes, all of the other trades will also close. So you will see this web, this net, where all of your trades close at one level. So here I chose a percentage of price based level, but you can also use a fixed pip amount, or you can use a percentage of ATR. Ultimately, as long as the expert advisor is calculating levels in an intelligent manner, you have some flexibility here. But to kind of show quickly how the math would look with the 0.1% of price level, here we can see the initial trade would have been a loss because you bought here and you closed here, right? So obviously that's a loss. So it's $1,000, which we're saying is the original trade size, times 2 times whatever the grid size is. So here the grid size is 0.1% of price. Therefore, trade 1 is the initial trade size, so 1x, times 2 times the grid size, which is -$2. Trade 2, it only went down 1 level. So you're doing grid size times 1, so 0.1%, times its trade size, which is double the first level, so 2,000. And that's also -2. but ultimately you get the point. Trade 3 is break even because the price returned to that level, and trade 4 is our winner, which covers all of the losses of the previous one. Here in particular, we're using a 2x, so this is the most basic form of martingale, where we literally double every time. So trade 4, just based on how exponential numbers work, would be actually greater than the required amount to cover the previous trades. This is why most intelligent martingale advisors wouldn't use a true 2x. They use a martingale factor, which I will show you in a spreadsheet shortly, but there are other ways of doing this which are a bit less risky. But this is grid martingale in a nutshell. This is how it works, and it's based on mean reversion principles, which essentially states that if two assets or if a pair is correlated, or you have two pairs which are correlated or co-integrated, I believe is the actual term, there's a pretty good likelihood that it will eventually return to the mean. And provided your asset doesn't trend too long in one direction, eventually one trade should hopefully go in your favor, enabling you to close in a profit. And that's why this system works particularly well with mean reverting assets. So if somebody tries to sell you an expert advisor that trades trending assets with a grid martingale, I would be rather careful. So moving on, this is just something that I wanted to share, which is how I personally developed martingale expert advisors. And it was a kind of an iteration on the classic style, and I called it the flipping grid. So essentially, at a certain point, what I noticed is that if you continuously take trades in the exact same direction, I viewed that as a bit primitive, because if you clearly enter a new trend, should you not try to take trades with the trend? So how this essentially worked is that I created the flipping grid, and I'm sure somebody else has done this already, but this is something which came to mind, where essentially you have a trend filter baked into your MetaTrader or baked into your expert advisor, so that if the market starts to trend against your grid, you flip the side of your grid. So to give a more concrete example here, we were initially going long and price started to go against us. If a certain trend filter was triggered at this level of the grid, so the the third level of the grid, instead of taking another long, hoping it would go up, we would suddenly take a short here. So then what would have happened is now we're using almost a combination of hedging plus grid, and this trade in a short would have been significantly larger than the previous two and would have been able to cover the losses from the other ones. So to break down the math here, the first trade would be $1,000, so the same trade size, times 3 negative grid levels. The second trade, 2,000, so 2x, times 2 negative grid levels. But trade 3, it would be the exact proper amount to cover the previous trades. So in this case, it would be 7,000, as it would be enough to generate $7 effectively and cover the previous trades. So this is something which I tested out, and I ran live on my own accounts. I would not be comfortable selling it, but it is something to perhaps look into if you are set on using a martingale style of money management. So now I wanted to jump into Excel to show you how this would actually look if we were to extend it beyond a few trades. So this example shows the exact same grid which we were mentioning previously, but with a larger account balance. But effectively, the grid size is 0.1%, and we're using a martingale factor of 2. And what this shows, and what I'd want to draw your attention to, is how using a martingale causes your lots to increase literally exponentially. So with a starting lot size or starting trade size of 0.08, after 10 trades, we are trading over 40 lots, which is an astronomically large amount of size. And as you can see here, this little table represents the amount risked, or like the max risk per level. We are at 162% of the account at 10 trades, which is an enormous amount, and you would be extremely margin called at that level. Even here at 9 trades, we're getting to close to 81%, and you would get margin called by your broker then. And here we can also see this table represents exactly what we saw in the PowerPoint. So what different trades would effectively close at, like which ones are in profit, which ones are in loss. And as you can see, characteristics of a martingale, your final trade is significantly larger than the prior ones, and that would enable you to have profitability once each net closes. Something which I wanted to draw your attention to as well is the martingale factor of 2 is typically quite high risk, and most good expert advisor developers who favor martingale wouldn't want to use a 2. Like if we were to switch this to 1.6, you can see that how the lots scale is significantly more conservative, right? So after the same 10 trades, we're trading 5 lots as opposed to 40 lots. And the downside here is you can see that if your grids start to go beyond 4 levels or 5 levels, or so 5 levels and beyond, you start to close them in the losses. So effectively, your final trade does not scale as rapidly if you were to use a more aggressive martingale factor, which enables you to not always be profitable, but you are significantly reducing your risk. So keep an eye out for the martingale factor. So when you are trying to evaluate an expert advisor, that is something very key to look at. So the purpose of this spreadsheet was really to show you how lot sizing can increase exponentially when using a martingale system, and to pay attention to the martingale factor. And one more thing too is what really struck me and why I personally don't love trading martingale is because you are heavily limited in your initial lot size if you want to trade safely. So in this spreadsheet, I was attempting to model if we have an emergency stop loss. So essentially an equity stop where if you go 15% or 10% into drawdown, you should simply kill the system and close all trades and cut your losses. However, there's always a trade-off between how much trades, how much size you can use, and how often your emergency loss or your emergency stop loss will be hit. And what I found is that as soon as you start to use any meaningful trade size, if you want to keep your risk relatively conservative, it becomes very challenging. Because here, we are keeping at 9 trades, we would lose around 14%. So we are already fairly limited by how much actual size we can use. So in a conventional system, I would typically trade with significantly more than 0.08 lots, even especially with currency. So here you are using a very small lot size, or not very small, but relatively small lot size relative to the account balance, because you do not want to have your lots scale enormously. To be a bit more concise, if I were to make this 0.2 for instance, you can see that we have significantly faster lot size scaling, and our emergency loss would be far greater. So that's something to keep in mind. Really the downside of martingale is that it also heavily limits your ability to use larger lot sizes. So to not ramble on for too much longer, I will point out one more thing which I view as very key when evaluating martingale systems. When you're running backtests, and this was a Python-based backtest, you have to look at how large the grid becomes. So regardless of what platform you're using, you can likely do this in MT5 or other stress test simulators. You have to see what is the probability that a run will go beyond a certain amount of levels. So here this was a backtest with the Aussie dollar, New Zealand dollar, and we can see that it was quite solid. But if we were to run this with another currency or gold specifically, you would likely see far more major runs. So when you're running a backtest, really pay attention to the frequency of how often grids go beyond a certain level, because you're able to use that with your spreadsheet here or whatever model you would look at to see how likely are you to hit an emergency stop loss. The final point I'll make is when looking at any sort of martingale-based strategy, you should be very, very careful if it trades too many pairs. This was a good example of a recent popular martingale bot that blew up. Is they were trading, I think, like 11 pairs, and that is extremely, extremely risky, because the more pairs you have, the more likely you are to have a long run. And to my earlier point, the most important thing to look out for in martingales is the probability of a run exceeding whatever your loss limit is set at. So the more pairs you have, the more likely you are to have these larger grids, especially if you start using more trending assets. So to summarize, when you are conducting martingale backtests, always keep an eye out for multiple pairs. Always test the odds of having a larger grid and how frequently your grid goes to certain levels. And be very careful when using martingale factors, because the more aggressive a system scales, so it uses it 2 times or maybe even a 2.5 times, yes, you will always win, but your odds of blowing increase exponentially. Please leave me a comment if you have any questions. This was a bit more of a complex video, but hope you like, subscribe, and let me know. And stick around for the next short clip where we will share a non-martingale expert advisor with you, which is far better than the vast majority of martingale advisors on the market. Take care. Before you click away, if you're looking to get a real expert advisor, here at Prosperity Algo Solutions, we're currently offering our golden time bomb system based on automating the London breakout and opening range breakout 100% for free. Watch the pinned video to find out more and to get access.